Hello and welcome to this edition of Trinity Talks. Today we'll be talking about partial risk guarantees, PRG, and using PRG products. Today's talk will be held by partner Simon Norris and senior associate Joe Sykes. Simon will talk about the context of PRG instruments. What are they? What is PRG? And really setting an idea of where it's used. Joe will then go on to talk more about the structure of PRG documentation, talk about eligibility criteria that the institutions who offer them have, and also talk about other considerations to bear in mind. This is a two-parter. So tomorrow at the same time, we will be doing a deeper dive into some PRG issues. We'll be doing effectively what is an FAQ, frequently asked questions. We'll also be looking at some of the specificities for the Francophone market in part 2, and we'll be doing a little compare and contrast between other political risk mitigation tools, such as political risk insurance. So without further ado today, I will pass you to Simon Norris, who will start today's talk.
Thank you for that, Coach. So as Coach said, I'm here to set the scene, to tell you why we are here, not in a deep philosophical sense, but only in a PRG sense. So I'm going to talk around this wheel here from bottom left. So first of all, why is Trinity talking to you about this? Well, as a firm and as three individuals, Coach, Joe and I, we've worked on our fair share of transactions that involve the partial risk guarantee products. And we've done that in the context of power deals, so generally independent power projects, and also oil and gas transactions. We've negotiated PRG documents, but we've also drafted PRG documents for different institutions. And in fact, we've drafted them in both English and French, as Coach was alluding to earlier. In terms of countries where Trinity has had involvement in these products, I've listed those in that third wheel. So Nigeria, Kenya, Uganda, Zambia, Ethiopia, Malawi, and Sierra Leone, again, as I've said, across power and oil and gas transactions in those markets. And as we go through, or more accurately, as Joe talks to the trickier bits, we're going to use power or an IPP as an example. And we're going to do that for a variety of reasons, but perhaps the most important in the context of oversight of the PRG product. An IPP allows us to see two types of PRG product. We call one the debt mobilization product, and the second the liquidity PRG. In very basic terms, the debt mobilization product is a guarantee that benefits commercial lenders to, if I'm using an IPP as an example, to the generator, to the project company that's generating the power. And that guarantee will kick in and make payment of the next due debt obligation to the lenders if an underlying risk event occurs. So if an underlying aspect of the deal goes wrong, if there's a breach of contract fundamentally. The liquidity product is a guarantee that benefits an issuing bank that is going to issue a letter of credit on behalf of the off-taker, so the entity purchasing power in an IPP. And the benefit of that is that the off-taker need not offer cash collateral to that issuing bank, because the issuing bank will rely upon the fact that it's getting a guarantee from the AAA rated World Bank Group. On the next slide, I'm going to try to put the PRG into the context of political risk mitigation products and providers as a whole. So before I go around this pie chart, as we said at the top there is overlap between these. So this is more of a Venn diagram perhaps than I've made it look. So there we are, top right, we're talking specifically today to the World Bank partial risk guarantee products. They broadly fall into two camps. So we see policy-based guarantees and we see project-based guarantees. We're not actually going to talk to policy-based guarantees today, because those tend to be used where it is the government or the parastatal itself that is the borrower of funds. So for instance, if a government were issuing a bond and it was then going to use the proceeds from that bond to fund the infrastructure sector, that could feature a partial risk guarantee supporting the bond issuance. We're talking about project-based guarantees where there is a specific project. As I've said, we're going to tend to use an IPP, a power project as our example. But the World Bank Group's not the only entity that offers partial risk guarantee. Other multilaterals and development finance institutions do so. The African Development Bank, for instance, and the Asian Development Bank. Trinity's worked with the African Development Bank on the Lake Turkana wind project in northern Kenya, using the PRG as an example. We also see AB loan structures when it comes to political risk mitigation. So these feature an entity such as the IFC or Asian Development Bank as the A lender, the lender of record, lending money to a project. And behind them under a B loan structure, we have a commercial bank or banks that are benefiting from the protection from the better protection that the DFI, that is the A loan provider gets. So preferential tax treatment as an example. Moving around the wheel, we see those same DFIs and multilaterals offer guarantees that are not necessarily partial risk guarantees, but are guarantees in the context of other types of transactions, although again, there could well be some overlap. So these could be used in the context of a loan or a bond transaction. Carrying on around, political risk insurance. So political risk insurance is in some ways the biggest tool, I suppose, to deal with political risk in project finance transactions. And we see that split broadly into three. So when it comes to insurance, we see those insurance products offered either by the private market. So going to Lloyd's of London, there are, I think, around 20 syndicates that offer PRI in the private market. And we also see public players, again, that tend to be DFIs and multilaterals like MIGA and other parts of the World Bank Group. And then any or all of those entities can be involved in reinsuring the risk under the initial PRI policy. And the final piece of this pie, export credit agencies. So these are not a product as such, these are a provider. And we see those in the context, we also see them in the context of project finance deals. And they may well be doing some of the things I've already talked to. So they may well be offering up a guarantee. They can also make direct loans and they can also provide insurance. But the commonality being here that they are in a position to take on certain political risks. On the next slide, again, back to PRG. From a high level, I'm going to try to talk to, in broad terms, the types of risk that we mean when we talk about political risk. So on the left, in that attractive shade of orange that matches my shirt today, that's really where we see the PRG. So certainly in Trinity's experience, the partial risk guarantee product kicks in and makes a payment if there's been a breach of contract. So that would be a non-performance or a non-payment by the government or by the parastatal. So in an example of an IPP, if the off-taker fails to make a payment under the power purchase agreement, for instance, the PRG kicks in. But we also see other heads of political risk, expropriation, so where a government agency may have expropriated shares or assets that belong to the private sector. We see currency convertibility and transferability, so if you can't take local currency and convert it into hard currency, or once converted, transfer that money offshore. And then the third head there, war and terrorism. So each of those can be covered as standalone events, let's say through political risk insurance, and again, Coach will talk to some of that tomorrow, but we don't tend to see those directly covered by the PRG. But they can be indirectly covered because when you go back to the contract, so for instance, the power purchase agreement may well have these issues as triggers that trigger a payment obligation on the part of the off-taker, or indeed the government, and then should the off-taker or the government fail to make that payment, we've got breach of contract and the PRG kicks in. Hence, we say it's indirectly covered by the partial risk guarantee product. Now, hopefully that's given you a very high level idea of where PRG sits in the political risk world, and then it will allow Joe to talk about something much cleverer. Joe, over to you.
Thank you, Simon. So as Simon has alluded to, we're going to go now into a little more detail on the World Bank PRG product specifically. And we thought it might be helpful to start with a bit of an overview of the criteria that a project will need to meet in order to benefit from a World Bank partial risk guarantee product. So to start at the top of this slide, mobilising private investment. The key here is that the intention for the World Bank product is to initiate private investment into countries or sectors where perhaps that wouldn't ordinarily be so straightforward, and to assist in mitigating risk to the extent that allows that investment. So what that means is that a project looking to benefit from the World Bank products will need to demonstrate a private investment or private sector link. And often that is through debt provided by commercial lenders and or equity provided by private investors. So that needs to be met in order for the product to be made available. Member countries, because this is a World Bank product, the project will need to be being developed in a member country. So that's really an IDA country or an IBRD country, both of which fall under the World Bank umbrella. And what that really means in practice is that the PRG product is predominantly used in low and middle income countries. And obviously we come across its use in a number of sub-Saharan African countries in particular. Just by way of example, Nigeria is an IDA country where we have used the PRG product, as Simon had mentioned. And Zambia is an IBRD country where the product was used as part of the Scaling Solar programme. Partial risk acceptance. The clue here is in the name of the product, partial risk guarantee. What this means is that the World Bank does not take 100% of the risk that is covered by the product. Now, the reason for this is not that the World Bank is not willing to take 100% of the risk. It is more that by allowing the private sector to take some proportion of that risk, this is intended to encourage proper and thorough due diligence before investment is made into a project. It also has the advantage of ensuring that where the product is used, but the host government, or in our case of a power transaction, off-taker, does make payment and the partial risk guarantee is not called upon, then that country or off-taker is able to build up a payment record for non-guaranteed payments. And this can be beneficial from a wider economic perspective. Eligible sectors, not a huge amount to say here, but as Simon touched on, as a firm, we are very familiar using the PRG in the power sector. We've also seen it and used it in the oil and gas sectors, telecom sector, but that's by no means an exclusive list. Technically and financially sustainable, fairly self-explanatory, but I think the point to note here is really just that the World Bank, when assessing the sustainability of a project, will not look just at the short-term implications, but also as to whether the project is technically and financially sustainable in the long term. Country limit, we just wanted to touch on, just to draw attention to the fact that the World Bank Group does set a limit, a monetary limit, for the amount of support it can provide in any given country. Now, this limit is set based on a number of criteria and is reviewed by the World Bank periodically. What it's key to understand, though, is that by using a type of World Bank supporting country, you are reducing the value of that country limiting country. So if direct lending is made by the World Bank Group to a host government, the amount of that direct lending will be deducted from the country limit available. So this just needs to be borne in mind when looking at the size of PRG that a project might be applying for. We need to have as a reference point the amount of support that the World Bank is still able to provide in country and how much of that the use of the PRG may utilise. E&S and anti-corruption guidelines. No surprises here, I don't think. We've got the World Bank Group involved, and therefore they will expect any project to which the PRG may be applied to comply with World Bank standards in these respects. So that includes things like the IFC performance standards, which many of you will be familiar with. In the context of an internationally financed transaction, this shouldn't be a particular concern, as most investors and lenders will already have these requirements. So just a point to note. And finally on this slide, development impact. For the PRG to be deployed against a project, the World Bank Group will want to be confident that there's a demonstrable impact from a developmental perspective. So that might be a broad-based economic growth element, or a project that is aimed at increasing the effectiveness of a private or public sector. And all that we wanted to talk about here briefly was just that what this means is that a country in which a project is applying for support for the PRG is likely to need adequate macroeconomic policies and frameworks in place to enable it to accept and implement any policy or sector reforms that the World Bank may request as a condition to the deployment of the PRG. So moving on to the next slide. We thought that having set the scene, it might be worth just having a slightly more detailed look at the documentation structure and project structure of a transaction using, typical transaction using both the debt mobilisation and liquidity PRG products that Simon referred to. The structure here is actually a simplified version of the Azura IPP transaction in Nigeria. And on that transaction, we used both the debt mobilisation PRG and the liquidity PRG. Now, we'll come to a little more detail on both of those, but you can see that the key agreements in that respect are the debt mobilisation guarantee agreement in the top right of the structure and the liquidity guarantee agreement in the middle of the structure, both in the deeper orange colour. Now, clearly the structure is fairly complicated and we don't really have time today to go through that in any detail or to touch on all the intricacies of the documentation. But we did just want to draw attention to a couple of particular parties and documents that we thought might be of interest. And those are the ones shaded in a darker colour on this diagram. Also worth noting that in some places, just to assist with simplifying the structure, we've included terms like project agreements and indemnity agreements. Now, in those cases, because we were deploying both products on this particular transaction, that is actually 2 project agreements, one for the liquidity PRG, one for the debt mobilisation PRG, and 2 indemnity agreements. Again, one for liquidity, one for debt mobilisation. So taking that as our starting point, let's look to some of the parties and documents. On the left, we have the covered lenders. Now, these were the commercial banks that provided the private investment element for our debt mobilisation PRG. And they were all, as I say, commercial banks. That's not to say we didn't have DFIs or multilateral development banks as part of our structure. We absolutely did. But the debt was essentially divided into tranches so that the lenders benefiting directly from the PRG product were the commercial banks, who then entered into an intercreditor arrangement with the DFIs and multilaterals who sat in a slightly different tranche. So that's just a small intricacy that's worth bearing in mind. Sponsors, not a huge amount to say here, other than, again, they ticked our private investment box in terms of eligibility, and they were providing shareholder loans and other equity to the project. The World Bank Group sitting there more or less in the middle of the page. Clearly important involvement in the project, given that both products were being used. And as I've mentioned, we can see here that they provided the 2 key guarantee agreements. The first being the debt mobilisation guarantee, which directly benefited the covered lenders. And the second being the liquidity guarantee agreement, which directly benefited the LC issuing bank. Now, turning to the LC issuing bank, why is this party in the structure? As Simon alluded to earlier, in a power transaction in an IPP context, using the liquidity PRG is often done in order to allow a letter of credit to be issued to the project company, essentially under the power purchase agreement. So in this context, we had a power purchase agreement between a state-owned off-taker to the project company. And under that agreement, the project company required certain credit enhancements from the off-taker to support its payment obligations. This was an LC. In order for the LC issuing bank to have the confidence in issuing that LC without cash collateral, the liquidity PRG was utilised so that the LC issuing bank, instead of having to take a credit view on the off-taker, could look to the AAA rating of the World Bank Group and issue the LC on that basis. So that's where the LC and the LC issuing bank fit into the structure and really goes to the core of what the liquidity PRG product seeks to do. So I think the one document we haven't yet touched on in this structure is the indemnity agreement, or in this case, the indemnity agreements. There's a lot we could say on these agreements. They are slightly unusual in form. They don't contain a governing law clause, for example. But in the context of this wider look at the PRG, the key point to note here is that this is the agreement that creates a contractual nexus between the World Bank Group and the host government in the country in which the products are being deployed. And that can contain a number of obligations for the government to comply with in order to satisfy World Bank requirements. So it really is the key document that actually underpins the deployment of the PRG in country. So with that, I think we can move on to the next slide. As I say, we haven't been able to go into vast detail on the structure, but what we thought it would be helpful to do towards the end of today's session is instead to talk a little about the wider considerations that you might want to think about if contemplating using a PRG for a project or transaction. So starting in the top left of this slide, the halo effect. For anyone who has been involved in a project using the World Bank or another PRG product, you've probably heard the phrase halo effect. What does it mean? Well, the key point here, I think, is that for many involved in these transactions, the real value of the PRG is not necessarily its monetary value, but actually the relationships and other support that having the World Bank involved in a project gives. That might be through political relationships between the World Bank and the host government, or through the use of in-country representatives that the World Bank has on the ground. And in both cases, these might assist if a project starts to run into trouble in terms of addressing an issue before it becomes a major problem. So, of course, the monetary value of the project is important, but equally important is the involvement of the multilateral, in our case, the World Bank, in the project. The next one to look at just briefly is risk weighting. What do we mean by this? Well, as we've discussed, the PRG product is intended to mitigate risk relating to a particular project. So the logical hope would be that by mitigating that risk, you reduce the need for a lender to include that project on its books with any particular capital adequacy requirements in a similar way to where a guarantee is involved. However, it's worth noting that although the title of the product, partial risk guarantee, implies that the risk weighting may be reduced substantially, where a lender is considering lending to a project of this nature, the actual impact from a Basel or a capital adequacy perspective is fairly limited. So yes, it offers a lot of comfort and mitigates a number of risks. That just is not necessarily fully reflected in the capital requirements associated with the lending. Government balance sheets. Two quick points to note here. PRG is both advantageous and potentially disadvantageous from a government balance sheet perspective. The good news is that by encouraging private sector investment, the host government is likely to be able to move a substantial upfront cost for a key infrastructure project off its balance sheet. That cost is now met by the private sector. However, as we've touched on, in order to deploy the PRG, the World Bank will require the government to enter into an indemnity agreement, Under that indemnity agreement, the government will take on certain liabilities, and as a result, it will need to account for those on its balance sheet in accordance with applicable accounting standards. Macroeconomic policy framework and sector reform. Again, something we've mentioned briefly today already, but there will likely be requirements from a World Bank perspective for a country to implement certain new policies or reforms as part of the rollout of a PRG product. Now, generally, I think we would say this is a positive development, generally looking to strengthen sectors or institutions within the country. But from a purely political perspective, those reforms could, of course, have some short-term pain, and that may or may not be acceptable to a political person or party within a country when looking to deploy the product. So it just needs to be borne in mind in the context of those wider discussions with government. Briefly on the nature of the LC itself. We've discussed the reasons for having the LC in a liquidity PRG scenario, particularly in the power sector. One thing just to bear in mind is that the PRG LC does not take the same form as your standard commercial standby letter of credit. Now, that's not to say it is not a very useful LC and it doesn't have the desired effect, but just wanted to draw attention really to the fact that it is a conditional LC, not an unconditional LC. It is subject to certain termination and suspension rights relating to various defaults or events of default under the wider PRG document structure. And just from looking at it, it's a very lengthy document. It's not a 1 or 2 page commercial LC like you might be used to seeing. Now, as I say, none of this is necessarily a bad thing. The LC is utilised widely and actually has the advantage of generally having a much longer term than a commercial LC would. But it is something to bear in mind when looking at the documentation package for a project. And finally, timing considerations. Just again, a couple of points to note here for anyone looking at a prospective project that might use the PRG. I think there's 3 key points to touch on here. If you're looking to deploy the PRG in a country where it hasn't been used previously, you do need to bear in mind that there will be discussions between the World Bank Group and the host government, and potentially your off-taker in a power transaction, as to the overall structuring of the transaction and the contents of your indemnity agreement. Now, those discussions may well go smoothly, but there is obviously a timing implication to having to have those in order to put the framework in place in country before the project can move forwards and actually achieve financial close. Second point relates to the more general PRG documentation, which we had touched on in the structure slide. Again, the documents follow a standard form generally, but that doesn't mean that some time is not required sitting down with all the parties involved in order to finalise documents and get them executed. So just something else to bear in mind in a project timeline. And finally, conditions precedent. In the run-up to financial close, obviously, as a developer or a project company, you will have numerous CPs to satisfy on the lender side. Again, just worth bearing in mind that the World Bank then also has its own set of conditions precedent before the PRG product can become effective. So with more parties around the table, more documents to discuss, you are potentially looking at needing a little longer there. As I say, none of this is to say that the product is not very effective and its deployment cannot be very efficient, but these are all things that need to be borne in mind as you're moving into a transaction using the PRG. So I think that's about all we have time for on the overview today. We hope it's been helpful. But I think now if we could move Kaushik to any questions that we've received, please.
Thanks very much, Joe. And thank you, Simon, for your introduction and the context setting for PRG products, and Joe, your deeper dive into the structure and into some of the other eligibility considerations in using the products. We've had a number of great questions, both on the Q&A and sent to us separately. So if I may, Simon and Joe, I'm going to just fire a couple at you and see where we go. Joe, in your talk, you talked about needing time to negotiate the PRG documents. One of the questions has come, aren't they just standard form documents? So is there really an issue in terms of timing for negotiation of those?
Thanks, Coach. That's a very good question. And I think what I would say here from experience is it's really a question of context. Where the product is being deployed in the context of a pre-agreed program, for example, scaling solar, often the documents are 90–95% complete when they are received as part of the package. So all then that needs doing is filling in essentially bespoke details and then just finalising and executing. However, in a standalone IPP context, we can find that there's a little more for discussion. And I think this is a positive. I would say the World Bank Group team, when we've been dealing with them, have generally been very pragmatic and willing to enter into discussions about the nature of the risks to be covered, timelines, whether or not a disputed amount will be covered, various other points that then do, by their very nature, just require a little further discussion. And equally, the interplay between the finance documents and the PRG documents can sometimes take a little bit of time to agree and finalise. So I think it goes both ways, as I say. Yes, they are standard form documents. However, they do contain the ability to have some flexible provisions in them to make them a little more bespoke in certain situations.
Okay, thank you for that response, Joe. I agree. It will depend on the transaction, but very often there is a need to go bespoke, as it were. Yeah. Another couple of questions have come in. I'm actually going to turn to Simon, if I may, for the next one. Simon, in your part of the discussion, you touched briefly on some of the other political risk mitigation products. I'll be talking about some of those tomorrow, but the question has come whether you or whether Trinity has worked on transactions where these products have been used together. So where there's been a PRG and then, in addition, an AB loan structure, for example. Have you done that, or do they tend to only be used on a standalone basis?
Thanks, Coach. Another good question. Yeah, we've seen them. We've seen the PRG product used on a standalone basis where it's the only political risk mitigation tool on the deal, but equally good examples, perhaps in the larger transactions. So actually the Azura transaction in Nigeria is a very good example in which we saw the MEGA guarantee being used to cover equity and debt. So therefore you had both the PRG product and the MEGA product covering commercial lenders. And that made for an interesting interaction between the two because the coverages don't work exactly the same. So going back to Joe's point about how quickly and easily you can negotiate these products where they're then interacting with a second or a third product, as we saw in that deal, then inevitably there are slightly more complex aspects to negotiate. Not least of which, and I'm not sure Joe necessarily touched on this, but when you take one of these products, what the team will do, whether you're dealing with MEGA on the PRI side or whether you're dealing with the World Bank team on the PRG side, is they will do an underlying look at the risk that they could cover in the document. So this is not just a sort of a standard checklist of risks that are covered. They will do an analysis of the particular breaches under the particular PPA or the particular government support agreement, and then you get to discuss and negotiate those with the team. And if you're negotiating those both with, say, MEGA and the PRG team, then inevitably it's slightly more complex. But actually, in my experience, both teams have been fantastic to deal with. So it might be more complex, might take a little more time, but you end up with a very neat solution.
Thanks very much for that, Si. We've got a really large number of questions coming in, so I'm going to just fire a couple more. Tomorrow's session is also a deeper dive into some of the PRG products, but more importantly, we'll be going through FAQs, and a number of the questions that have been raised actually touch on what we're going to discuss tomorrow as well, particularly in relation to timing and a bit of a deeper dive into some of the structural elements. So if you have asked a question and we don't get round to answering it today, please make sure you stay tuned for tomorrow. Joe, back to you. One of the sponsor clients has messaged saying they appreciate the need for the World Bank to be involved in the financial close process, but do the developers need to consider the World Bank's involvement on an ongoing basis? And I should also say that, you know, we're talking about the World Bank PRG specifically. Obviously, other providers such as Asian Development Bank and AFDB are available, but I think your answer, Joe, will no doubt answer both, apply to both.
Thanks, Kaushik. Yeah, it's a good question, and it is something that does sometimes get overlooked in transactions. You know, the project reaches financial close, everyone's pleased to be under construction, but then what happens if there's a change going forwards, or some kind of consent request that goes out to lenders? Do you at that point need to consider your PRG provider? And the short answer here is yes, you do. Certainly in the World Bank PRG context, you've got an agreement called your project agreement, which we touched on, which is between the World Bank Group and your project company. And essentially what that is like a light version of your CTA or your facility agreement. And it contains a number of obligations that the project company undertakes to the World Bank Group. And therefore, often what you find is if your finance documents require you to go out to lenders for consent in respect of a change or entry into a new agreement or something similar, your project agreement will also require you to do the same when it comes to the World Bank Group. So often you end up with two parallel consent processes, one for lenders, one for the World Bank Group. Again, doesn't need to have timing implications as such. They can be run in parallel and they will be very similar, but it is definitely something to bear in mind going forwards.
Okay, thanks for that. Thanks for that, Joe. We had a couple more questions, so I'm going to ask you a couple in quick succession, if I may. One in relation to FX, so FX availability and convertibility risk. Obviously, that's a key issue in a number of jurisdictions. And the question comes whether the PRG, as we've been describing it, has a role to play in addressing those concerns, specifically in relation to FX. And the other one, which is sort of a tied question, is other than liquidity, and we've talked a lot about liquidity risk, can you give some other examples of using PRGs?
I can have a go at both of those. And if I get them wrong, you can correct them in part 2 tomorrow. So that's good. Let's take the second one first. So when we've been talking about an example such as Azura in Nigeria, the PRG products there were both liquidity, i.e. the one that supports the issuance of a letter of credit on behalf of the off-taker, but also the debt mobilization products. There was a guarantee issued to commercial lenders that protected commercial lenders against certain covered risks as well. So the debt mobilization product means that should a covered risk occur, so some sort of failure to perform by the off-taker or the government in the underlying contracts, then a payment is made under the guarantee to the covered lenders that essentially makes the next payment that is due, the next debt payment due, it makes that payment to the lenders. So it's not strictly covering liquidity as such, I suppose, or rather it's not necessarily covering liquidity when we use the phrase liquidity PRG, because we're using that to describe the letter of credit product, albeit it is covering liquidity risk in that the project company at that point in time is not sufficiently liquid to meet the net debt service obligation. However, it can also be used, the PRG can be used in a termination scenario, albeit that's not always the case. That's something that the entity giving the guarantee will always have to contemplate on a transaction by transaction basis. But we've certainly advised on projects in which where we have a termination event in the underlying contract, and that termination event would trigger a payment obligation by the government or the parastatal entity, the off-taker in our IPP example. If the government or off-taker then fails to make that payment obligation on termination, then the PRG could make a payment to the covered lenders or the covered entity to the project company. As I say, that tends to be, that's not the standard off-the-shelf PRG, as it were. That's very much something that would be made on a project-by-project basis.
Thanks for that, Simon. We are being flooded with questions. I'll take one. Someone's asked, PRG LCs. We mentioned that PRG LCs are not unconditional, and can we provide some examples of typical conditions other than payment default that would apply to the LC liquidity PRGs? It's a very good question. Typically, the LC documentation will have suspension and termination rights. So effectively allowing the LC bank to say, I'm putting the letter of credit itself on hold, or ultimately terminating it and releasing that cover. Clearly, they're very important things to consider, both for lenders and for sponsors to an IPP or to an infrastructure project. Really, they're relatively limited. So they fall into, I guess, two main baskets. The first one are going to be things like policy provisions, and that's a very broad term. So there will be DFI policy provisions. Usually they are environmental and social related, and secondly, they relate to anti-corruption, bribery, collusive practices, and so forth. Those are likely to be, and they would be triggered by the project company effectively breaching those policy or those anti-corruption guidelines. Sometimes may extend to affiliates of the project company. The reality is, if the project is being financed, even if it's only being financed by commercial lenders, frankly, the likelihood is that there will be a very similar covenant package in respect to, for example, IFC performance standards, and certainly any typical financing would include anti-corruption provisions. So it shouldn't be any more burdensome than the project company has already signed up to. But it's important to note that whether it's the World Bank Group or AFDB or another DFI, they also need ultimately to ensure that the monies that they ultimately would be providing on are covered and are protected by these policy matters. The other kind of main basket of things are events that relate to the LC bank itself. So what if the LC bank itself becomes insolvent, or there's some issue that, for example, there could be a sanctions or a corruption issue with the LC bank itself. That will trigger either a suspension or a termination, depending on the event, and that would give the provider of the guarantee, so the World Bank Group, IDA, the opportunity to replace the LC bank. So that's an idea, just a bit of an idea of some of the conditions that could apply that would prevent the LC actually being in place. But in the grand scheme of things, these are risks that should be acceptable to both sponsors and developers of an IPP. We're coming up to our allotted time, coming up to 1:45. We've got a whole slew of additional questions, so I think what the best thing to do is we're going to take a look at the questions that have been asked. A number of them relate to timing, some of them more specifically on the documentation itself. We will factor those in, create our FAQs for tomorrow's presentation, and then answer the questions tomorrow in our slide presentation. And we'll also talk about some of the differences between PRG, PRI, and other political risk mitigants, as well as talking about some of the specificities for the Francophone market when looking at PRG products. So with that, just leaves me to say a big thank you to Joe and to Simon for their talk. All three of us, and in fact all of the Trinity team, are available to answer any questions that you might have on PRG products. Feel free to email Simon, Joe, or myself directly if you have any specific questions that you don't want aired in a public forum. But otherwise, hopefully you can join tomorrow, and thanks very much for attending today.